Welcome back, traders and investors. We have Kevin McPartland, Principal of Market Structure and Technology at Greenwich Associates. Kevin, how you doing this morning?
Great. How are you?
We're doing good. We're on this merger Monday here. Did you have any of these takeover stocks on your radar or not?
I, I wish I had that kind of foresight about about who's buying what, but my expertise lies elsewhere, unfortunately.
Okay, you wrote a interesting article here about the brokers making more money last year than or this year than the year before, and that kind of breaks the trend. Do you want to talk about that article a little bit?
Yeah, we did. We published some research just last week. We talked to about 600 institutional investors about how they interact with the brokers and how much they're trading and what they're paying. And it turned out that sort of for the sort of previous year, sort of ending in Feb 2014, they made about 10% more in total commissions than they made the year before, which was the first time there'd been an increase in that number in almost 5 years. So definitely a good sign, although still a long way away from sort of the good years of equity brokerage, if you will.
Is that just because trading volumes are starting to come back up there, Kevin, or what is the reasoning behind that?
Yeah, no, I mean, quite the contrary, right? I mean, the volumes are still pretty low. Volatility is unbelievably low, which is
Yeah.
neither of those things is very good for the brokerage business. But what we do seem to be seeing, our customers more now than ever are really searching for good research, right? They want to understand both sector-specific, stock-specific research, but also research to help them understand the market structure trends and what's going on in Washington, right? Because especially since Flash Boys was published, it's really sort of reignited the whole debate about how the equity markets work in the U.S. So customers seem to be willing to pay up for good, essentially for good information.
So firms are basically now they want to understand where their orders are going, maybe a little bit more too. Do you think that's involved?
No
More.
question. Yep, we have another study set to come out in a couple of weeks where we sort of examine the role of the sales trader, right? I think there's sort of this preconceived notion that the equity markets are all electronic, when the reality is over half of institutional customer orders are still placed through the phone. So we wanted to understand
Wow.
what are those, what, yeah, it sort of always surprises people, and what's the role of the sales trader, and that's was one of the sort of the biggest responses that the big brokers told us when we asked what customers were inquiring about most. And a lot of it was, where is my order going? Where is it ultimately being executed, and at what price? And it's surprisingly, there's a lot less transparency there today than I think most of us would have expected.
And so you're talking about like the research brokers, like the Goldman Sachs, the Morgan Stanleys, the to provide the good institutional research. Are those the ones that are making more money, or is it your little independent brokers? I don't want to say little, but your interactive, your Thinkorswims. I mean, because those companies really don't provide much research. Who's been the recipient of this increase?
Yeah, so you ask a great question, and the short answer is it's a little bit of both. But I think the more interesting trend has been towards actually towards the mid-tier brokers, right? As the larger firms have seen their margins squeezed quite a bit, they've spent quite a bit of time and money focused on the electronic offerings, the algorithms and such that they've been providing. They've unfortunately had to sort of scale back on their research departments, especially for small cap stocks, lower volume stocks, and that's where these mid-tier brokers come in. So if we take a look at the market share of the sort of mid-tier brokers as compared to the bulge bracket, it's been a dramatic change since 2007. Whereas the bulge bracket, we're sort of between 70 and 80% of the research commission market in 2007. That number's dropped down to 60 or so. Whereas it's all that sort of difference has been made up by these mid-tier brokers who are specialists, and their business model is different. They're less focused on the electronic and more focused on that high-touch model. So it's sort of been a real sort of big change that looks like it will continue over the next couple of years.
So you mentioned Flash Boys. Obviously, there's been a lot of talk about market structure and are the markets rigged and all the other stuff that the media has kind of grabbed from the book. What do you think's going to happen here with market structure? Is the SEC really reviewing here, and do you see some significant changes coming?
So should we start off with the market's not rigged?
Okay, we'll get that out. So Kevin
Yeah,
says the market's not rigged.
The market's not real. Let's get that out. I mean, it's certainly complicated, and I guess sort of my caveat to that is it's way more complicated than it needs to be. It's sort of, grown up that way over years of change. But yeah, so will we see some real change? It's tough to say. I mean, it's even when the regulators talk a big game and they have sort of good intentions, the unfortunate side of regulations and what goes on in Washington is they still sort of are have to deal with the politics of the situation, right? We've seen this throughout the implementation of Dodd-Frank and the derivatives rules as well, right? So despite some, best intentions and some good ideas, you really can only put forward what will get the votes. So, the things that are, I guess, being focused on the most now are high-frequency traders, sort of as a collective having to register as broker-dealers, and then some new regulations on dark pools. So, I mean, on the former, in my opinion, it would be great to put something in place that incents those guys from registering as something. So maybe if you are, required to register as a market maker, for instance, which means you're going to be there when the markets are good and when the markets are bad, which I think is what people want. You need to make it worth their while to stay there when basically to catch the falling knife when the markets are bad. But it'll sort of they'll find it worth it for doing that in the good times. And then on the dark pool front, I mean, I think there's a big difference between what we think of as a block crossing network and a dark pool, right? So if you want to help institutional investors cross large blocks, which is the 10,000, 20,000,
like
share
a liquid net or
orders.
something. Yeah.
Yeah, exactly what LiquidNet was founded on, right? I think there's a huge utility for that. It's hard to get big orders done without moving the market, versus just sort of a pool that's more focused on anonymity, and you're still doing the 200 share orders that you could do on the exchange. So I think there's some. I think we need to separate those two, and hopefully the regulators will figure out a way to incent platforms that let those big orders get done for the institutions. And let's remember those institutions. That's our money, right? Most of that is retail money, those mutual funds and such. Let's let them get those orders done, and maybe push some of those smaller executions back onto some of the electronic exchanges.
The SEC back in 2010 in their concept release mentioned the concept of a Tradeout rule, which actually would bring priority back to the displayed national bid best offer. Do you see, I know there's been some talks that, something like that could happen in the small caps, maybe, on a pilot basis. Do you see a potential Tradeout rule coming where they would try to drive some of these smaller, orders back onto the lit exchanges?
I mean, probably not as it's written today. This is another one of those topics that you could go on for hours about. It's complicated. I don't think it's politically palpable as it's written. So I think they'll have to fiddle with that rule a little bit to make it work for everybody. But I guess it shows the intention. It shows that they're trying to figure out how to reform the market. I still just go back to being concerned that we're going to make things more complicated than they are. I mean, what I like about what the guys at IEX are doing, right, is they're coming to the market with a new model. If the model works, if the market likes it, it will do well. If the market has sort of other priorities and they're not as concerned, then it won't, right? And that's sort of the free market approach. That's the other way to do it, rather than just putting more regulations on top of regulations. So we'll see how it goes. I mean, that's the way these markets should function. Let the investors and the users of those services choose how they want to consume them.
What about the small cap market, though? Just looking, obviously we have lots of liquidity in the big caps. You can look at a Bank America, and there's just so much liquidity there. It's very liquid. But the small caps have struggled with liquidity for a long time here, and it doesn't seem to be getting any better. Do you think there's any, thing that they can do there? Do you think this widening the tick that they were talking about potentially could help?
I mean, that might incent more market makers to come in if they think they can make a little bit more money there. But if the stocks are illiquid to begin with, the spreads are already wide, right? So, I mean, this is just going to come down to what investors want in their portfolio, and you can't force that. That said, if we ever get volume and volatility back over the VIX back over 11, then they'll, rising tides lift all boats, right? So they're never going to be, like you said, the small cap is never going to be Apple, but it certainly could get better as the whole market hopefully starts to move again, right? Maybe, I don't know what the catalyst will be. Do we need interest rates to rise, jobs growth to increase? I don't know what the catalyst is, but I think everybody needs the market to start moving again, so for us to see some good change.
Well, Joel, is there anything else you want to ask Kevin here? we lose Joel?
Nope, I'm back. I'm back.
Oh,
Was
Joel is back there.
just
He was
unmute that.
sleeping on
No,
the.
I was just just going back kind of to your article and looking at some of the banks and some of the brokerage stocks and really it like a stock like Goldman Sachs that just had a recent breakout, and you gotta say that they provide some of the best research on Wall Street. But it was nowhere near its all-time high. I mean, a lot of that is because of the lack of trading. The trading's been taken out from Dodd-Frank. Are these stocks? I mean, do you think this is a trend? It's going to continue? And taking a look at like stocks like Morgan Stanley and Goldman Sachs, Goldman or Morgan way off its all-time highs. I mean, are these a way to participate on your thesis here in the market and increase trading activity? Or are investors better off, sticking with your interactive brokers, your TD and Ameritrade stocks?
Yeah, so I mean, we have to remember that these top banks, even though their business models are changing, they're still controlling a big chunk of a lot of these markets, right? So even as I pointed out before, the mid-tier brokers have picked up a lot of ground. The bulge bracket, which really is only 9 firms, makes up 64% of the commission share. And that sort of mid-tier bucket, as I'm calling it, is going to be dozens of firms. So these are still firms that, like as you said, provide some of the best research. They undoubtedly provide some of the best execution tools on the market. In fact, a lot of those mid-tier brokers that we spoke with said that, in fact, they link their customers back to some of those bulge bracket execution tools. So that's not going anywhere. But you're certainly going to see the banks continue to restructure for all this change that's gone on. There was a story today in the Wall Street Journal looking at Credit Suisse looking to spin off part of its fixed income business, and I think these are all I think they're structural changes that maybe we never expected to come. We never would have thought 6 years ago this is where we would have ended up. But these are smart people that are going to restructure their businesses in such a way that they can continue to be successful and make money. So I'll leave you guys and your listeners to decide where to put their money. But the mid tier are certainly rising, but the big banks, they are not going anywhere, and we need them in these markets.
Right, not only to provide liquidity, but obviously their research and is very valuable, and that's according to your article here, that's what investors are paying for. But the little guy doesn't. You think the smaller investors? You think they need to be paying more attention to the research that these firms are putting out? I mean, I think people are really disillusioned with their brokers and the markets in 2008, 2009. That's the reason a lot of people are underinvested now. You think that they should perhaps be with some of these larger firms or maybe some investment advisors that follow the research of these firms?
Yeah, I mean, I think like any decisions like this, you look to multiple sources, which is easier today than ever, right? Because there's so much available. Even through your retail brokerage account, there's so much information available. And if you even some of the big institutional investors, when they're sort of analyzing something, right, they'll look to their own estimates, they'll look to a third party's estimates, and they'll look to their broker's estimates, and they'll throw them all in a pot and use that to make their decision. And I think that's a sort of a good approach to take for retail investors as well, right? Look at multiple sources, and from those you can use those to make your own decisions rather than just relying on one person's word or what you're reading in the paper that morning, or hearing from you guys for that matter.
Yeah, exactly. We try and interpret what you hear from the street, also the pre-market trading and the activity that goes on to try identify big sellers and big buyers. Just go into a little bit, just general market here. Amazing run the market's had. Still, I guess from some of the people we've had on our show and out and about, you Doug Casses, you still have some people bearish this market out here. Maybe that's driving it higher, but I guess it all comes down to the interest rates and what the Fed does. So, do you expect this slow drift upward to continue until we get some kind of change on the interest rate front?
It seems to be the big catalyst for everything, right? For the last couple of years, monetary policy. I mean, they're certainly already scaling back, and the jobs numbers are getting better. And just like volatility, interest rates can't get any lower. Although I say that, and you saw last week in Europe, they actually made interest rates go below zero. but I don't think the U.S. Fed has that in mind. So, Yeah, I mean, it's really a lot of this comes back to macroeconomics, right? It's sort of when is the picture going to improve to such a point that people feel comfortable. I'll admit it's hard to figure out where to put money today, right? The equities markets seem so high, the fixed income markets equally high, and both there's reasons why both of them should start to decline over time. So it's tough to figure out what to do. It's not an easy environment for investors, big and small.
No, not at all. Okay, we've had Kevin McPartland, Principal of Market Structure and Technology at Greenwich Associates, giving his take on how the brokers did last year, market structure, and the research that's available by some of these Wall Street firms. Kevin, thanks a lot for coming on. Have a good week, and we'll hope to have you back on.
Thanks for having me, guys. Great talking to you this morning.
Okay, Kevin McPartland.